Imagine you've got $10,000 sitting in your bank account, ready to invest. You open your phone, pull up the market, and think, I'll wait, it feels high right now. I'll jump in when it crashes and get a better deal. Sounds smart, right? Buy low, not high. That's basic logic. But here's the catch. History shows that people who wait for the right moment almost never actually invest that money at all. The crash they're waiting for either doesn't come for years, or when it finally does, they're too scared to buy then either. Let's be honest, I'll wait for a dip is one of the most expensive sentences in personal finance, and today we're going to show you exactly why. Why does this matter to you? Because waiting for a crash isn't a neutral decision. It's not doing nothing while you figure things out. It's an active choice with a cost that compounds every single day your money sits on the sidelines. Most people don't realize that the market spends far more time going up than it does crashing. So the strategy of wait for the crash isn't just risky statistically, it's betting against how markets actually behave most of the time. Let's start with what a crash actually is. In market terms, a crash or correction typically refers to a drop of 10% or more from a recent high, and a bear market usually means a drop of 20% or more. These do happen regularly, in fact. But here's the part that surprises people. They're the exception, not the norm. Think of the stock market like a staircase with occasional trapdoors. Most of the time, you're climbing slowly, sometimes boringly, one step at a time. Every so often, a trapdoor opens and you drop down a few steps. But historically, the staircase has always kept going up over the long run, and each drop has eventually been followed by new, higher steps. The problem with waiting for the trapdoor is that you don't know when it opens, how far down it goes, or when it closes again. And while you're standing there waiting, the staircase keeps climbing without you. Here's the insight that changes how most people think about this. Being invested during the market's best days matters far more than avoiding its worst days. Some of the market's strongest days in history have happened extremely close to its worst days, often within the same week, sometimes even the same month. That means an investor trying to dodge the bad days by sitting in cash runs a very real risk of also missing the best days, because they tend to cluster together during periods of high volatility. And missing even a small handful of those best days can quietly wreck decades of returns. This is why time in the market consistently outperforms timing the market for the vast majority of investors. Not because timing is impossible in theory, but because doing it correctly, over and over, with precision, is something almost nobody actually pulls off. Let's put real numbers behind this. Research often cited from studies on missed best days shows a consistent pattern. An investor who stayed fully invested in the S&P 500 over a multi-decade period earns dramatically higher returns than one who tries to time entries and exits but ends up missing just the 10 or 20 best trading days. Along the way, even if that second investor was in cash during some of the worst days too. Now let's make this tangible with a character. Meet Priya. In 2010, Priya has $10,000 saved and wants to invest it. But she watches the news, hears economists warning about a coming correction, and decides to wait for a better entry point. She waits through 2011, then 2012. Every year, prices look too high compared to the year before, so she keeps waiting. By 2015, she's still holding cash, still waiting for the crash that will make her feel safe. Meanwhile, the market, with all its ups and downs along the way, has moved significantly higher. Now compare that to her friend Marcus, who invested that same $10,000 back in 2010 and simply left it alone, riding through every dip and every recovery along the way, including real corrections in 2011, 2015, 2018, and 2020. Despite living through multiple genuine crashes, Marcus ends up dramatically ahead of Priya, not because he predicted anything, but because he was actually in the market while it did what markets tend to do over long periods, grow. Priya wasn't wrong that crashes happened. She was wrong about what waiting for them would cost her. Now, I want to be fair here. This isn't an argument that market timing never works or that valuations don't matter at all. Buying at extremely elevated valuations does tend to lower future expected returns to some degree, and that's a real data-supported pattern worth understanding. It's also not saying you should invest money you'll need soon, like a house down payment in the next year or two, into the stock market just because time in the market wins. Short time horizons and long time horizons call for different strategies entirely. And to be clear, this isn't a guarantee. Markets can go through extended periods of underperformance, and past patterns of recovery aren't promises about the future. Someone investing a lump sum right before a historically severe downturn will still feel real pain in the short term, even if history suggests recovery eventually comes. The point isn't that timing never matters even a little. The point is that trying to precisely time entries based on a feeling that it's too high right now is a strategy with a very poor track record, and the cost of being wrong compounds silently year after year. So what should you actually do instead of waiting for a crash? First, consider dollar cost averaging, investing a fixed amount on a regular schedule regardless of what the market is doing. This removes the emotional guesswork entirely and ensures you're capturing both the dips and the best days without having to predict either. Second, if you already have a lump sum sitting in cash that you don't need short-term, understand that historically, investing it all at once has outperformed waiting for a better entry point in the majority of rolling time periods studied. Splitting it into a few tranches over several months can help with the emotional side, but indefinitely waiting for the crash is a different thing entirely from a reasonable, phased entry. Third, write down your actual time horizon. If your money isn't needed for 10, 20, 30 years, short-term market timing shouldn't be driving the decision at all. This is exactly why understanding your own horizon matters more than trying to read tea leaves in daily headlines. Does it really matter if the market dips 15% right after you invest? Not really, not if your money is staying invested for decades. What matters is whether your money was actually working during all those years you might have otherwise spent waiting. If this made you rethink sitting on the sidelines, that's exactly what this channel is here for. If you enjoyed the video, please like and subscribe, and I'll see you in the next one.